All right. Hey there, real estate friends. Mike Nuss coming to you today. We've had a lot of demand and requests to record the market update that I did at our last real estate meeting there in July. So today, I'm going to record this, a quick recap of the market update. Lots of stuff going on there. We'll get to the nitty gritty stuff that we need to see. One thing I did for July was I went through 30 years of our local Portland RMLS real estate data and created a custom spreadsheet. So that way we can kind of try and see what was going on at a macro level in those real estate cycles to understand what cycles have happened in the past, where are we at right now, and what can we learn from those past cycles and how they may apply to what's going on now. Because one thing we do know is wherever our market's going right now, A, it is changing, B, it's changing relatively rapidly, at least the lending environment is. And what the theme and the frame of previous cycles will not be the same as this next real estate cycle. But we'll get into that spreadsheet and the details of it because there are some clear cycles and themes we can see through it. Here's what we went over briefly, macro update, PDX numbers, affordability, we'll talk about that as well, the fancy spreadsheet that I just talked about. And then if we have time, we'll get to some Mike's takes. From a macro environment standpoint, what we really just need to understand is that we're going from a very hawkish monetary policy, meaning, from a very dovish monetary policy, meaning the economy is not strong, right? The dove is weak, a hawk is strong. In a dovish policy mindset, the economy is not strong, and so we support that economy. We do quantitative easing, we have lower interest rates, we do lots of lending, we print more money, we add stimulus to the economy. In a hawkish environment, we do the opposite. We start pulling stimulus out of the economy. And so what has the Fed done? They stopped purchasing financial instruments. They have increased interest rates significantly to start fighting inflation. And so what we need to understand is the Fed has two mandates. They need to price control, so inflation, and maximum employment, so unemployment or the economy. So think of it as in fighting inflation, or at least controlling inflation so that prices are growing, but not so fast that that disrupts the economy. At the same time, how is the overall economy doing? What are the jobs looking like? And so they need to fight those two things because the tools that they have help one, hurt the other, right? So if the economy is a concern, if the economy is a dovish concern, well, then they add stimulus to the economy, which then can create too much inflation. So now if they want to fight inflation, now that the concern is what do they do to the job market, and then what does that do to then the overall economy? And so they have this tightrope that they need to walk, and they've changed course. They did a very good job signaling at the end of 2021, we are going to stop making financial purchases. We are going to increase interest rates. And as the data comes in, they changed their timelines. Early on in COVID, it was interest rates are going to be at zero till the end of 2023. And as the economy ramped up much faster than expectations were on the recovery, that timeline became sooner and sooner and sooner and sooner and sooner. Kind of the theme through the first half of 2021 is inflation was transitory, right? That was the big word that the Fed kept using. And so they were not addressing inflation until it got to the point in the fall of last year that now we have to do something about that. So that's when they started the communication of we're going to stop purchasing financial instruments, we're going to increase interest rates, and the market has reacted to that. Now, when they actually started taking action on increasing interest rates and stopping their financial instrument purchases, financial asset purchases, that also coincided with the Ukraine war, and we still had the supply chain disruptions. And so we've got a lot of stuff going on that's now creating this new policy, and different markets reacting differently, one of them being the bond market. So immediately, the 10-year Treasury note, the yields skyrocketed. And then what happened then? Mortgage rates skyrocketed. And what we're going to see, we'll talk about a little bit more, is they reacted much faster than the Fed did. And mortgage rates, the secondary lending market, acted faster than the bond market did. So now there's a spread where, in my mind, interest rates are a little higher than they should be based on where the 10-year yield is and the bond market is. But we'll talk a little bit more about that. So let's get into Portland here. The big number here is supply. So essentially from March to June, supply doubled. We went from 0.7 months to 1.4 months. This is why I really like that 30-year spreadsheet that I created, because that seems significant. Supply doubled, or competition reduced significantly amongst buyers. Here's the thing though, a doubling in supply just goes from a really, really, really unhealthy market to a less unhealthy market. And we actually still need more inventory, more options for buyers in order to get back to a healthy marketplace. We'll look at that spreadsheet and the heat map that does. But what can also happen is we can almost double this number again, and it will still be a healthy marketplace. The last time we had a really kind of flat market was back here when we got around the 3 months of supply. So when you look at 2018 to 2019, we had a pretty flat market. So that's when we got, for the majority of the time, we were over 2 months, right? It's the back half of 2018, we're over 2 months of supply, approaching three in the winter, which is common for inventory to grow, supply levels to grow during the winter. And then really for the most part above 2.5 or flooding around 2.5. So we can still take on more supply, still see values go up. There needs to be a collaboration to actually know what values are, what true market value really is. And that's the thing. We're switching from a market that's so hot, so exacerbated, still wasn't as hot as 2004, 5, and 6 and 7, but still a very, very hot market, which is unhealthy because we can't make good purchasing decisions because you're all rushed. You have the leverage of really, 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 really low interest rates, which makes bidding wars very easy to create, which pushes values up much faster and easier. So we're in an environment that was very unhealthy. It seemed great from a real estate agent standpoint. If you're selling property, you feel really good. Buyers are frustrated, but at least they're getting really amazing rates locked in for 30 years. So it may have seemed okay, but that's not a healthy marketplace. So we're going from a very unhealthy marketplace to a healthier marketplace. And ultimately, we do need to have a healthy housing industry for our overall economy to work. And so what's happening is not necessarily a bad thing. It's, in my mind, actually a good thing. We do need the inventory, but to go there and to go there so fast and have the interest rates change so fast is going to create chaos. It's creating volatility. And through that, we're going to have some pain as well. So we'll talk about that as well. Here's the big thing is inventory spike. At the end of the month, this is really what it comes down to. There's two factors that create that supply level calculation. It's how many homes are left on the market at the end of the month. It's about 4,000, which is a significant increase, right? So this time of year it goes up, but it goes up relatively slowly before going back down. So we had this huge spike at a time of the year where we typically don't see a huge spike. But let's put that into, again, relative terms. That huge spike of inventory got us back to COVID levels of inventory, post-COVID levels of inventory. We're still not even up to pre-COVID levels of inventory, right? These are healthy housing markets, 17, 18, and 19 healthy housing markets. Now, 2012 to 2017, values were going like this, like crazy. And then the Fed pulled stimulus out of the economy. The Fed started pulling stimulus out of the economy. We saw a flattening market from 2018 to 2019. We created an inverted yield curve happened at the end of 2019, and then the Fed stepped back in and added stimulus to the economy in the form of asset purchases, financial asset purchases, mortgage-backed securities, which then, that was late 2019, really primed 2020 for a really good real estate market. January and February were great, then we had COVID happen, right? So you can kind of, we'll see that in the other slides. But so putting this all into context and getting relative on it, we still don't have much inventory on the market. Even though it seems like, oh my gosh, what happened? Supply levels doubled. We still don't have a lot of inventory. Okay, new listings. So again, here, new listings are not, it's not like a whole bunch of sellers came to the market. That's not why we have more inventory at the end of the month. It's because demand's dissipating. And why is demand dissipating? It's expected, right? Demand slows down when interest rates go up, right? The urgency has been sucked out of the market. So that's the conversation I've been having in my presentations and with individuals, is that we went from 2 years of an over-exacerbated market with not enough sellers, lots of buyers, really good interest rates, lots of bidding wars, and a lot of urgency, right? Get your interest rate now while you still can. Get your property now before values continue to go up. So that creates a lot of urgency. Then we have the Fed policy change at the end of the year. What did that create? The hottest January I've ever seen in my real estate career. What did we see? Fed's jumpers, right? So now the Fed's telling us rates are going to go up. The bond market's telling us rates are going to go up. And so now you get another wave of demand to get pushed in, and then rates do start going up, and rates start going up quickly. So then that creates another rush of urgency to get that interest rate now while you still can. Fast forward to June and July, and where we're at now, the interest rates are much higher. Purchase prices are the highest they've ever been. We did come down a little bit in June, but in May, they were the highest they've ever been. And the affordability is the lowest that it's ever been since the 1990s. So that's not necessarily a bad marketplace. It just means there's no urgency left to purchase. And so what do we see? Closed sales went down. Okay. So that's your absorption rate. For the supply levels, it's how many homes are left on the market to purchase at the end of the month, divided by the amount of closed sales in the month, right? So you have just over 4,000 divided by just under 3,000 creates your 1.4 months of supply. Closed sales are a lagging indicator, though. That's the important part. What we want to see is pending sales. And so this is why for like listing agents and sellers, you feel like the market's dropped off, is because pending sales, even though pending sales typically go down this time of year, this is the tip of the market where the amount of activity slows down. It just went down at a much quicker rate. Again, why? Because the urgency was sucked out of the market. So if you had open houses in the first couple weekends of July, you probably felt like a big empty arena out there. It's the dog days of summer. It typically demand slows down a little bit in summer. There's more sellers in the summer. And so supply levels kind of grow before they shrink, and buyers have options. So you're enjoying summer. Interest rates are pretty high. Prices are pretty high. There's no urgency left to go buy your house now. Now, it doesn't mean people don't want to buy homes, and it doesn't mean that they're not qualified to buy homes. It means that there's less urgency now. There's the least amount of urgency today than we've seen since the early days of COVID. That's kind of where we're at in the marketplace. We talked about all that stuff. So what happened? We talked about this. The urgency was sucked out of the marketplace. I'll just keep this here so you can screenshot and see kind of my thought process of it. And then here's the good thing, right? Forced bidding wars. Buyers don't want to be in bidding wars, but we are in a market conditions that force bidding wars. That's unhealthy. So now we're going from a market where there are still some bidding wars, there's still competing offers, but for the most part, buyers are going to make well-informed decisions. And if you look at the definition of market value as an appraiser, I was always taught, and this is the essence of what an appraisal is you're appraising based off of a definition of market value. What's in the definition of market value? Non-distressed seller, non-distressed buyer. It's really hard to state that you can say as a buying pool over the past 18 months, it's been a non-distressed buying environment, right? And so immediately when you think about forced bidding wars, that is not the definition of market value. So that's where we talk about the calibration, the value calibration needs to happen. We don't really know where that's out. It is going to shake its way out, and we'll talk more about that. Okay, so here are the numbers. We did see month-to-month price depreciation. So for the year, we're still up 10% year to date on what the prices are, median sales price for this first 6 months of the year compared to the last first 6 months of the year. Now, this is the month-to-month decline, but that's common. One thing I talked about is that's common. So if you go to June, decline, June, decline, June, decline, June, decline, June, decline, or right around there, right? And what does this correlate to? It correlates to less demand, right? It's a supply demand issue at the end of the day. Yes, interest rates matter. Yes, effective purchasing power matters, but what you're going to find matters more is competition. And the competition amongst buyers to be able to buy from sellers, or vice versa, the competition amongst sellers to fight for buyers. And because we saw a quick increase in interest rates and we saw a quick pull of urgency from the market, we quickly went from extreme buyer competition to now sellers need to compete just to get buyers in the door while we're going through these dog days of summer. So it's a really unique change. It's nothing that I've ever seen in my 20 plus year career. It's kind of vice versa of the what happened prior to the crash, and we can talk more about that, but it's expected. At the end of the day, when I talk about the market over the past more than 12 months, I've been saying the values need to be calibrated. The market is unhealthy. We don't know what true market value is. It needs to calibrate itself. Never once did I think that calibration process would be really easy, would be overnight, and it would not be painful. And so right now we're feeling the effects of it. Overall, though, when we'll get into the spreadsheet and talk about the health of it. So here's a good way that exemplifies that. Back in December, affordability, your mortgage payment, which affordability is defined as your mortgage payment being 25% or less than your gross income, was good. So we're under 25% of your gross income, which made affordability more than 100%. Well, that quickly declined. So in May, it went down to 80%. One thing I talked about 2 months ago was that we're based off 2021 incomes, which was 96.9 in that equation, 96,609, and that the number, our 2022 income numbers would come out. They did. They came out June 15th. And it's up 10%. So incomes went up. So when you think about that exacerbated marketplace with all the urgency and all the buyer demand and all the bidding wars, well, incomes were up, right? So even though we went through COVID, incomes were up, interest rates are really low, purchasing power was the highest it's ever been. That creates those values. To where we're at today, so as of July, based on June's median sales price, interest rates as of 7.7, 5.3. Now, last I looked at 7.14, they went up to 5.52, and I haven't looked since, but I do believe I heard someone say they came back in. So that puts our affordability at 87%. So I don't think of this as this is the key indicator of the marketplace. I think of this as a heat indicator, right? So when affordability is up over 100%, that's a very hot indicator that buyers are ready to transact, right? It makes lots of sense for buyers to be buying homes. So the heat indicator there is really, really, really strong. When we're down here around 87%, it doesn't mean that there aren't buyers, and it doesn't mean that the market's drying up. It just means that they're not as urgent, right? The heat indicator is low. They can still transact. There's still plenty of lending going on. Interest rates are still low. This may not feel low, but historically it is really low. And so it can transact. The urgency is just dissipated almost overnight. Oh yeah, I like to project, right? I do projections. So what I want to do is let's solve for 100%. So by solving for 100%, what needs to happen in order for this number to come up? Either interest rates need to go down, incomes are set, right? 2020 incomes are set. That's a fixed input. So one of these two things need to change. Either interest rates come down or the price comes down. So if we solve for interest rate, we need to get to 4.1% to get this number to 25% of our income, right? So we're obviously a percentage point ahead of that. If we want to solve for median sales price, keeping interest rate the same, reducing the sales price to get this to 25%, that's a 12.7% drop. So what I'm saying, again, go back to the heat indicator. I'm not saying the market needs to come down 12.7%, but I do think the market's overheated. I do think that it does need to correct itself. And it's probably somewhere between rates need to be under 5% and the median sales price needs to come down less than 12%. I think there's a median ground in there somewhere where we can get this number closer to 100%, which then brings demand back into the marketplace, increases that heat, and that's what sellers want. So let's go here and take a look at, where are my tabs? Here we go, comparison chart. So here's the 30 years worth of data that I created for this presentation. So essentially, I'm just looking at a few indicators here and all the years here. So closed sales year to date. Now, I didn't want to have to do a lot of math. So I took the June RMLS market action report. I took all of the year to date activity, number of closed sales year to date, number of closed sales in the month of June. So here's more of a collaborative, cumulative amount of data. This is a point in time data. I don't like point in time data, but I had to do it this way to save me from creating a significant amount of math. So we got some cumulative data. Then I used the closed sales the number of June and the inventory left on the market at the end of the June, so we could get supply levels. So we can have a comparison of supply levels. And then I wanted to throw in our interest rates trending up or down. Was there quantitative easing going on? And then what's more important here is kind of the sales prices. So I did it in two ways, both as like this heat map based on an individual number. So here in 1992, you can see supply levels were over 6 months. That is typically considered a declining market, or more than it's a buyer's market. Yes, a buyer's market, not a seller's market. Interest rates were pretty high. You come down here to the mid 90s, supply levels were in that 3.5 to 5.5 month range. That's not bad. It's not good. It's an even level of competition. What I want to show today, though, is I did this a heat map based on a healthy market. So essentially, green's a healthy market. Blue, we'll talk about this. And then I created themes through it. So I got into the market here in 1997, and kind of the theme through the early 90s was this was a really hot real estate market. It was also a really hot refinance market. And if you look at that, that was not interest rate driven. If you look over the period of time, this was the highest the interest rates have been in the past 30 years. And it wasn't interest rates that was really driving the market. It was pretty ho-hum. By ho-hum, I mean 3.5 to 5.5 months of supply. So it wasn't a seller's market. It wasn't necessarily a buyer's market. But because of affordability being really high, that really was able to push interest rates up. So even though we didn't have ridiculously low supply levels, which creates a lot more buyer competition to push up these numbers, this was really an affordability driven marketplace. Then we had the dot-com crash, and you can see that show up here. Now, what happened after the dot-com crash is this is where we reset our interest rate cycle. This is when the Feds, for the first time, really started lowering interest rates. So if you look at like a 40-year map of the Fed's prime rate, it's high, it goes higher, and then it starts crashing, right? So after 2000, so this is like a macro change of interest levels. Again, it was really a ho-hum market though. Supply levels weren't, they were pretty even. It wasn't a buyer's market, it wasn't a seller's market. Interest rates were still relatively high. And then this is values were going up, but they weren't going up like they were back here because affordability had come, lower affordability after the dot-com crash. And so that's more like a normal kind of operating market. This is a cycle that you expect. Then what we did in 2003, how do I move this? That's not what I'm gonna do. Here. Here we go. Okay, and then here's the culprit. So what we then switched to was new loan products coming out. So essentially, bankers don't like this, right? If you think about it, nothing's really sexy. There's not a whole lot of sales activity going on. They're not making as many mortgages. We also just got done with the refinance boom in the late 90s, so they're not doing a lot of refinances, right? Well, what do? Let's create different loan products, right? Let's create more loan products so we can expand our borrower pool, right? Think of it that way. Our pool of borrowers is not increasing and they're not transacting. We're not making any money. So if we change our loan programs and we expand our our pool of borrowers, we can now make more loans. And then that showed up in the marketplace. And so 2004, 5, 6, that's when values started going up like crazy, right? And that's because of the types of loans that came out. So this was a mortgage credit availability balloon. We talk about the housing crash and the financial crash. We need to understand is the financial crash was created by a credit availability boom, giving too much credit, putting too much money in the hands of people that shouldn't necessarily have that money, won't necessarily make the best decisions with that money. So you create this environment where rates go up, values go up significantly, and then that pulls in even more buyers that want to go in there and flip their houses and make their 50 and 60 grand. And then we had this in 2007, that's when the first subprime lenders started going under. And so you can see the rate of appreciation slowed before it started going down. And this is where that crash happened. The stock market crashed 2008, bottomed out in 2009. And then we had this flood of foreclosure activity. We had so much inventory when these values are going down. This is the inventory that was this was just the month of June for these months. But if you look at the entire years, we had some months where inventory was upper teens, even in the low 20s, because it was so volatile. The amount of buyers coming and going, the amount of closed transactions was so volatile. On top of all the short sales coming onto the market. And then the word shadow inventory was created back in the mid. So we didn't even know how much inventory was. There was so much inventory that Wall Street had to start buying houses by the thousands in order to stabilize our inventory. And then what's happened? What Walmart purchased are now no longer going to be sold to owner occupants, right? Now that is a security. It is essentially a tradable asset that now just gets traded. The owners of those houses will always be hedge fund A, selling to hedge fund B, selling to hedge fund C. So that was necessary just to get inventory levels down to a point where now in the early 2010s, we could have a functioning market again. But what that did, and this is where I think we need to understand these themes. This was a deleveraging theme, and what that did, it changed how households, when household, to deleverage household debt, consumer debt, a lot of it comes to do with the mortgage. That also reset our consumer activity post-crash. Savings rates were higher, borrowing rates were a lot less. We had, going into 2020, prior to COVID, we had the lowest amount of consumer debt, the lowest amount of mortgage debt, and the most amount of net worth and home equity than we've seen historically. And that was a byproduct of changing our financial decisions post-crash. And then let's look at the theme of the early 2010s here. So it's the recovery, right? Interest rates, they had to drop the interest rates to get it functioning. But what's really going on here? Competition. You're under 3 months of supply. That's what you really need to look at, is once we got under 3 months of supply, once the competition swung from sellers to buyers, that's when these prices really started to increase. Then the economy started to slow in 2018. Supply levels increased a little bit. Interest rates increased a little bit, slowing the market down. But even though the market slowed down, it still was an appreciating market. 2019 was pretty flat. 2018 and 19 was flat. And I talked about the inverted yield curve, and then the Fed going from adding stimulus to the economy, pulling stimulus to from the economy, and then record stimulus to the economy. So you can see this quick swing here. And then I highlighted this stuff in kind of pink because this is a healthy market. That's what I talked about. Defined by really low interest rates and really low levels of supply, to the point where now we've got a doubling of supply and interest rates higher. So kind of when I hear the people screaming for a housing crash is coming, housing crash is coming, it's not based in actual data, right? It's based in emotion. So what are the things they're saying? Interest rates are killing the market. Okay, well, let's look historically. Yeah, from 2012, 2010 to 2020, 5.3 is at the top end of the interest rate. I get that because we started a brand new debt cycle. We had to start a brand new debt cycle because we just deleveraged, lowering interest rates, refinancing, getting out of selling, whatever was necessary to deleverage resulted in the low interest rates were part of that. But if we go back historically and we look at these interest rate numbers, 5.3% was never seen, right? We got down to there at that point, right? This was a byproduct of the crash. It didn't lead up to the crash. It didn't cause the crash. The crash had already happened. These low interest rates making our 5.3% feel high are a byproduct of a new debt cycle. But if you go back in time, never once did we ever approach 5.3%. Okay, so interest rates are not killing our market, right? I talked about how increasing interest rates pulled urgency out of the market, but it didn't kill our market. The other thing that I hear saying is the amount of sales activity. So this is the number of closed sales in the month of June. This is the number of closed sales in the first 6 months. These numbers are pretty high, but they're not exacerbatedly high. If you average 2020 and 21, you kind of get a better number because of COVID disrupted that. But if you look back in time, 2,900 houses in the month of June, that's not a really high number, right? So here you can see the demand sucked out of the market here in the crash. The demand sucked out, pushes inventory high, and that's where the value is going down. So the other thing is the number of closed transactions, around 15,000. We're kind of up and under these numbers, but still we're fewer than those. And it's kind of 14,000, 13 to 14,000. That's commonplace. So it's not like the market doesn't have buyers. It's not like the market dried up. It's just going from an unhealthy, exasperated market to a healthier market. Now, we have had all these huge price increases here, right? 2021 specifically. And this isn't even a good indicator for 2020 because this was in June, the market hadn't wrapped up. If you look at the back half of 2020, this is a point in time number, June to June. If you look in the back half of 2020 and the point in time indicators in, they're much higher. So you have these 2 years where we have huge appreciation driven by really, really low supply levels, lots of competition, low interest rates. And so when I say the values need to be calibrated, that's this kind of unraveling. But it doesn't mean that we're going back to values of way back here, right? It means this is pretty exacerbated here. We need to find out really where that's at. And interest rates are a part of that, but they don't define the market, they're a component of the market. So that's kind of where we're at there. I thought that spreadsheet was good to look at. Here, I will give my takes. So what's really important is the Fed is not selling their financial instruments off. They're letting them mature. So they're not, the other thing I've heard is the Fed is sucking money out of the economy. No, they're not. Now, if they sold their financial instruments saying, hey, we have $8 trillion of financial investments, if they took those to the marketplace, that sucks investment money out of the market, right? So think when they were down here, what happened? They bought financial instruments from investors. So investors held these instruments, institutional investors. The Fed gives them money for those instruments, and then those investors take that money, invest it in the economy. So that's how you stimulate, right? Say investors, this money's stagnant. You've already spent that money. You're earning a rate of return. We're going to buy those from you. We're going to get that rate of return, and you're going to take that money. You're going to invest it. And then that happens. What happens is this is the Fed selling off their financial instruments. This is taking money out of the economy. So if they sell their instruments off, now they're saying, investors, you have money that's supposed to go into the economy or be invested in the economy. Nope, we're going to sell these assets. You're going to buy them from us, and we're going to take your invested capital. Instead of going into the economy to stimulate the economy, it's going to us, and it's not going to be in the economy. And so when they started to reduce their balance sheet, that's when we had the taper tantrum. That's when we had an inverted yield curve. And then what did I talk about? Late 2019, they started quantitative easing. They started stimulus again. Then COVID happened, and then we went to ridiculous levels of stimulus. And so the Fed has said, hey, we can sell our financial instruments, but what they're also saying is we're a little concerned about the economy. We know we need to fight inflation. We're taking the steps to fight inflation, but we are a little concerned about the economy. So we're not going to sell our instruments. We're going to let them mature. And the definition of the maturity of a debt obligation is not, it's not adding to the economy. It's not taking from the economy. It's matured, meaning there's no longer a debt and there's no longer a credit on different balance sheets. So it's just a net neutral to the marketplace. This is very smart. The Fed starts selling off their financial instruments, then I get concerned, right? If inflation has been so crazy that they are saying interest rates are not doing it, increasing interest rates are not doing enough. Now we need to sell our financial instruments. That's where I get a little bit concerned, and that's kind of what I pay attention to. This is longer than I expected, but we're going through because I think this is data, good data. Again, typical upward trend. We see ups and downs month to month. You'll see swings in values, but the general trend is up. We're going to see month to month decline. So at the end of the day, if our values need to get to, say, if our values at the end of December 2020 are equal to the values of the end of 2021, so a flat 2022, our values have to come down from where they are right now. So we'll see month over month declines until this, essentially, in my mind, we're going from a stimulated market to a non-stimulated market. So this appreciation curve needs to flatten out. The only way for it is like it did in 2018, 2019. The only way for it to flatten out is for values to come down. So we'll see month over month price reductions. Now that may cause some concern. That may reduce, may affect in the consumer mindset, consumer sentiment. So that's definitely on mine. But I do expect this to come down and then flatten out before, again, it gets to, we do have long-term inventory issues, especially here in Portland, and then we get back on an upward trajectory. But it does, we're going to see this happen kind of like right here, boom, kind of goes down, flattens out before going up. I do expect that to happen. Fed, okay, so watch the Fed funds rate. So when I did this, they're meeting next week to increase rates. They're 1.21. So if they do a 75 basis points increase, they're 1.96. If they do a full percentage point, they're 2.21. Well, what's the bond rate at? The 10-year yield right now is at 3%, like just under 3%. So as this number approaches 3%, now you're going to have short-term rates. This is a different type of inverted yield curve. It's interesting now, the federal funds effective rate, that's banks, the rate that banks can borrow from each other. So that's not open to the entire investment world. So it's not going to have an effect like other inverted yield curves, but it's interesting to watch. I think that the Feds aren't going to have the ability to bring this number up above the 10-year Treasury note. We understand mortgage rates are tied to the 10-year Treasury note, not this. And I think they're going to find a ceiling of what they can do with interest rates. And we're already a lot of concerns about recession. There's recessionary flags that are out. So they have to fight inflation, but they also understand there's only so much that they can do before they start affecting the economy. And I do expect them to stop this. I do expect interest rates, based on when I did this presentation, created it, there was like a 2.4% spread. The yield spread, meaning yields on 10-year notes were less than 3%, mortgages were more than 5.3%. So that was a 2.4 spread. Historically, we're 1.5 to 2. Right? The spread is normally 1.5 to 2. So we have a higher than normal yield spread. I think you'll see if you watch what's happening in the 10-year treasury note, it keeps getting up around over 3 and going back down, up to 3.25, going back down. So it feels like the 10-year treasury note and the bond market are hitting these ceilings and coming back down, but then that spread between mortgage rates is now still too high. So I do expect mortgage rates to come down. I do think that will help with affordability. That will stimulate the market. The important thing to think is mortgage credit availability. We don't have really, really high mortgage credit availability. We have functional mortgage credit availability. We don't want low. We don't want high. We want functional. That's where we're at, and I think we'll continue to be in there. I talked about that. Mortgage rates come down. I think that's because of the spread. I think the yield curve is on top of it. And the other thing is distress is not, in my opinion, distress will not be a theme of the next market cycle. There is the big forbearance concern early in COVID. That number's obviously come back down. Now these are still high numbers relatively, but there's not a level of concern here. A lot of people that were up here, they've refinanced out, they did loan modifications based on the interest rate environment at that time. They're now secure again, and there are just a small amount of people that aren't. Now, there will be distress in the market. I'm not saying that there won't ever be distress, but we've always had distress in the marketplace. What's different about the housing crash is that distress defined the marketplace. There was so much distress, we created a level of shadow inventory, and Wall Street had to get involved to bail us out of that. If you want to say bail us out of it. So we're not going to get to that level of distress. It's going to keep inventory low. It's going to keep competition where competition should be. And so it'll be a functioning market rather than a stagnant market. I don't think we need to talk about this stuff as much. Yeah, so days on market will rise. Days on market, 18 days, that's just not enough, right? So that stuff will go up. It's going to be hard for inventory to come to the market. So that's the thing, is there's so many homeowners out there that have a 3% interest rate or less than a 3% interest rate, and they have a fixed payment. And so if the economy starts changing and they look at their options, if you look like a housing, a shelter, right? So the mortgage payment is part of your shelter. Everyone has to have a shelter component to their budget. So what do? You compare that shelter component of your budget to other options. Well, what if I were to sell and go rent? Well, if you were to sell right now and go rent, it's going to be more expensive to rent than it is to sell. Okay. So that's not going to help your month-to-month scenario. It may be, hey, at least we can tap into our equity. Now we have equity, now we have savings, and now we're going to rent. But by definition, that's not a distressed seller, right? It's not a short sale. It's not a bank-owned person. Well, what if I want to go buy a bigger house? Okay, well, you may be able to find, there's still a concern there, and you're a move-up buyer. You're not going to, it's not going to adversely affect the market where I'm selling and going to the rental market. And the other thing is, when you have your fixed interest rate, one of the components of the Great Crash is we had loans recasting. So not only were interest rates there, your ARM loans, your 5/1 ARM, you're paying interest only for 5 years. Interest rates went up, so your interest burden needs to go up. But now your loan recasted. It had to go to a 25-year amortization mortgage payment plus a higher interest rate. So your mortgage payment skyrocketed, which then created the distress. And then we made it socially okay to not pay your mortgage, right? So if you look at the Great Recession, there's the social component of, you weren't shamed if you weren't paying your mortgage. The majority of mortgage holders weren't paying their mortgage. And so we kind of made it socially acceptable to just live in your house. So to live in your house and not make payments. So what does that do? That hurts the rental market. And so what was interesting in the Great Recession is rents also went down. But that's opposite this time, right? Because the rental market is not going down, especially when you look at locally in the Portland, the state of Oregon, we created rent control. All of our screening criteria, our security deposits, our mandatory relocation, we created a policy that makes mom and pop landlords not want to be landlords. And I heard a stat recently on a podcast that 6,400 single family rental homes were sold in Portland last year. I can't remember the exact numbers, but it was a significant amount. And that's been the narrative at these city meetings I go to. That's the narrative, is we're reducing inventory, reducing inventory. And the problem with the single family world is our market's at a point where it's not economically feasible to build a single family home and rent it. So we're not adding inventory to the rental market. So what's happening, especially in the single family world, and rents are going up significantly. So in the single family world, rents are going up. And who's the home buyer that may sell to go rent? They don't want to go rent an apartment. They want to rent a house, but the rent's going up in that market segment, making that evaluation of, do I stay in my home? Do I not stay in my home? More favored to staying in the home and not bringing your home to the market, not helping the inventory, not exacerbating inventory to switch it to a buyer's market. So I'm really not concerned in the market. I think there will be a level of pain as we go through this calibration to find out truly what market values are. But what we need to understand is the market will function as we go through that, where when the market crashed previously, it was a financial crash. It was a credit crisis. It wasn't a housing crash. That crash was reflective of a credit crisis, not of an actual housing supply demand fundamental standpoint. Right now, what we're seeing is a fundamentals changing and shifting to get to a healthier place. It's not, in my mind, a crash scenario. So that's where we're at. Expect volatility in supply levels, amount of sales, interest rates, prices. But on the back end, expect a pretty more normal market. We'll have supply levels over 2 months. We'll have interest rates probably in the 4.5% to 5% range. I do expect them to come down under 5%. As the economy weakens, 10-year treasury notes, as institutional money flows into safe assets, the 10-year treasury note is the safest asset out there. Prices on that go down. Prices on the 10-year go up, yields go down, mortgage rates then also go down. So I kind of do expect that, and I expect the marketplace to level out before sometime in the relatively near future, when this financial shakeup calibration happens. We'll be in a marketplace where it's still defined by not a whole lot of inventory, stable buyers, stable sellers, stable interest rates, and more ho-hum price fluctuation. That's my crystal ball. It could be worth less than 2 cents, but we'll find out. So be amazing. Chat with y'all later. Bye.